One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights, the only podcast dedicated to helping you learn both the technical and non-technical aspects of investment banking. Hello, my name is Alex Mason, and I am so grateful that you're joining me today. We're going through it. We went through accounting. We went through valuation. We went through enterprise equity value, and we're going through discounted cash flow. And this level of question, this is a basic level discounted cash flow question, relates to cost of equity. We talked in the last episode about cost of equity and debt and that relationship. But today I want to talk about dividends. How are dividends related to cost of equity? Now, when we think about, first of all, definitions, basic definitions, right? What is cost of equity? Well, it reflects the hurdle rate that investors require in order to buy a business's stock, right? That's the basic definition. And when investors are looking to buy stock, what do they want to happen? They want the stock to go up, right? That seems pretty obvious. They want the stock to go up. And when the stock goes up and they sell it for a gain, that form of return is called capital gains. Capital gains. If you buy a stock for $100 a share, it goes up and you sell it for $200 a share, you have a capital gain of $100 per share. Pretty easy to understand. But you see, there are other ways to make money in the stock market in addition to watching a stock rise in price. And then one of the primary ways you can make money in the stock market other than capital gains is something called dividends. What is a dividend? Well, dividends are when a company writes a check to you as a shareholder simply because you own the stock. It is probably, in my opinion, one of the only true passive forms of income that exists, because as a shareholder, you literally do nothing. I mean, my family owns some stocks, and I just checked the brokerage account earlier today, in fact, and I just saw some dividend payments roll in, and it just made me happy to see that passive income just flowing in the account. Like, that's a dividend. Just because I own the stock, I get paid. And so that's another form of returns from the stock market. So if looking at all of these returns, you have dividends and you have capital gains, this is all a form of return for equity investors, right? So how are dividends reflected in this cost of equity? Because we know that equity investors are concerned with the cost of equity, and companies are dependent on whatever that cost of equity is in their assumptions for their financial models if they're making transactions. So how do we think about this? How are dividends included in the cost of equity calculation for equity investors? Now let's go back to that equation. Cost of equity equals the risk-free rate plus beta multiplied by the equity risk premium. Cost of equity equals risk-free rate plus beta multiplied by the equity risk premium. Now, which of these components would dividends be reflected in? Well, the answer is that dividends are reflected in beta. And when I first learned this, I was like, wait a minute, how does this make sense? How are dividends reflected in beta? Beta was talking about volatility. How does dividends have anything to do with that? But here's the thing. What does beta represent? It represents volatility, yes, but let's describe that another way. Beta represents the excess returns of a stock above the market. It also represents the excess returns of a stock above the market. So for example, if you were asked in an interview, what's your personal beta? That's kind of a weird question to ask, right? But I have heard that this question has actually been asked in investment banking interviews, by the way. So if someone asks, what's your personal beta? You might say, well, my personal beta is 1.3 because I am willing to bet on myself and I feel that I'm pretty competitive. So what are you saying there really with that answer? You're saying that you're going to deliver excess returns relative to the other candidates in the interview pool, right? That's really what you're saying. And so with this concept of dividends are a form of return in the market, and whatever the dividend yield on the stock is, it's going to be encapsulated in the total equity return, which in turn is going to be reflected in the beta, because the beta is representing the volatility and representing the excess returns that a stock could give relative to the market. So that's how I understand it. So yes, dividends are factored into the cost of equity. They are implied within the beta component. So that's what I got for you today on Investment Banking Insights. My name is Alex Mason and I am your host, and keep on listening, keep on sending me messages, keep on giving me suggestions or whatever else you want to talk about. My goal, my mission here, my mission here is to serve you. I want to help as many people as possible. I love doing this. And if I can help you in any way, just let me know. And we're going to continue going through this discounted cash flow stuff and then move on to other topics. But until then, have a great day.